Here we are, it's that time again. The Monetary Policy Committee have spoken. This group meet 8 times a year to decide what's going on with the Bank of England base rate, which is really influential. It has an impact on our mortgages, savings, and other finances. On Thursday, the 6th of February, they made the decision to cut the rate from 4.75% to 4.5%. 7 members of the MPC voted to reduce the base rate to 4.5%, while two wanted to cut it to 4.25%. But ultimately, it was decided based on sufficient progress on disinflation in domestic prices and wages that a gradual and careful approach was the way to go. The last meeting was on the 19th of December last year, where the base rate was held at 4.75% after being cut from 5% the month before. Now it's at a 20-month low. But what does it all mean? So the base rate is the rate the Bank of England charges lenders to borrow money. It influences what we are then charged when we take out mortgages and loans and the interest we earn on savings. So when the base rate is higher, we pay more for borrowing, but we also get better rewards for savings. The base rate is moved up and down to control inflation. So inflation is the increase in prices of goods and services over time. When inflation is high, it means the rate of things getting more expensive is speeding up. And then when it lowers, it still means things are getting more expensive, but just at a slower pace. So when inflation is high, the Bank of England might increase the base rate to try and stop people spending as much. The idea is if your borrowing is expensive, but savings rates are decent, you'll hopefully be spending less. This should, in theory, reduce the demand for buying stuff, and companies will lower prices or stop increasing them so quickly. And thus, inflation comes down and we go again. Now, the whole thing is a balancing act of managing rising prices against the risk of damaging the economy. Now, last year we expected a number of cuts that didn't happen, and many will be wondering whether this latest cut is the delayed start of the predicted reductions. Now, it's been a bit of a wild time economically recently. So, literally, in the days before the MPC meeting, we saw announcements from Trump about introducing trade tariffs, which have created a lot more economic uncertainty in the world. The committee acknowledged this in the minutes, but said as it's a rapidly evolving situation, we'll only know the true impact when the policies have been decided. However, it could prove inflationary, and this will have an impact on UK interest rates. So, what can we expect this year? Well, the Bank of England Governor, Andrew Bailey, said the committee will consider cutting rates again soon, but they'll be taking a careful approach as, he said, we live in an uncertain world and the road ahead will have bumps in it. He also said, we expect to be able to cut the base rate further as the disinflation process continues, but we will have to judge meeting by meeting how far and how fast. Now, one of these bumps seems to be the temporary spike in inflation to 3.7% in April, as predicted in the Bank of England's Monetary Policy Report, as a result of rising energy costs, which will factor into the MPC's decisions. Now, as usual, opinions are divided on how many cuts we'll see this year. Markets at the moment are predicting 2 or 3, whereas some economists are suggesting as many as 5. But of course, as ever, there's uncertainty around what will happen. Everything can change and none of this is guaranteed. But what you can be sure of is that we will update you as soon as we know what's going on with the base rate and what it means for your money. So what does it mean for your savings? So the past increases in the base rate were good news for savers. We've been earning very poor levels of interest, but that started to change in late 2021 and got better and better. But that's been changing since rates peaked in the autumn of 2023. Since then, rates have generally been falling as banks price in the predicted cuts and they're fast to pass these on, but slow to give us the increases. Many popular easy access accounts are now tracker rates, so they'll probably be dropping imminently in line with the cut. And since others are variable, they're likely to do the same. We have been seeing rates drop for some time now, but we expect to be kept really busy over the next few days and weeks, updating our best buy tables on becarefulwithyourcash.com/savings. And with mortgages, the decision means existing tracker rate deals will also drop by 0.25 percentage points. If you're on your lender's variable rate or SVR, you might see it come down too, depending on your lender. But what we did see about an hour after this latest bank decision was announced, Santander confirmed it would pass on the full cut to its variable rate mortgage customers from the 3rd of March. If you're already on a fixed rate mortgage, which most people are, nothing will change during your fixed period. Now, it can be confusing to homeowners that despite the base rate being lower now compared to, say, a year ago, average mortgage rates are actually higher. This is because mortgage rates are actually influenced by swap rates. So these are influenced by long term predictions as well as the wider economy and other factors. What it means is this latest base rate cut isn't going to prompt mortgage rates to fall overnight. If we're expecting further cuts to take more time to come through, it could mean that there's not much movement downwards on new fixes for now. It's always worth speaking with a mortgage broker who can advise on different strategies, though. However, since no one knows what will happen, this still won't guarantee any savings. And anyone who's really struggling to make their repayments, it's important to talk to your lender to see if anything can be worked out. Though do bear in mind, missing payments can impact your credit report. If it's impacting other essential spending, then see whether those companies can support reduced repayments. And if debts have built up, do speak to a debt charity. And that's it. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.